Big news today. Just a few days ago, Scott Bessent delivered a warning that shook Wall Street. The US dollar is facing its deepest crisis since the 1970s. For half a century, the dollar has been the foundation of global trade, the currency that underpinned almost every deal across borders. And now, in August 2025, that foundation is starting to crack. The pressure is already showing in the numbers. In July alone, global investors pulled out $13.6 billion from U.S. equity funds and sent that capital overseas. Europe, Asia, and emerging markets are now attracting the money that once reliably flowed into American stocks. This isn't just routine repositioning. This is the largest withdrawal in more than 4 years. Investors aren't moving money on a hunch. They're looking for safer ground and better returns because they no longer trust the stability of the U.S. market. What makes this even more telling is the sentiment behind those moves. The majority of institutional investors openly admit that American equities are overpriced. They see values on the screen that don't match real performance on the ground. And they're not alone in this assessment. A recent Bank of America survey found that 7 out of 10 fund managers now expect stagflation, a toxic mix where inflation remains high while growth slows to a crawl. Even more striking, 9 out of 10 believe U.S. stocks are trading far above their fair value. That combination explains why portfolios are shifting. Managers are scaling back their U.S. exposure and leaning more heavily into gold, emerging market assets, and international holdings. They're preparing for a period where growth stalls, inflation eats into returns, and the dollar loses part of its appeal as a safe haven. What we're seeing isn't a short-term correction. It's the early stages of a much larger rebalancing. Before we dive deeper into what this means and how it connects to U.S. policy, make sure you're subscribed. Now let's break down the full picture. Let's begin with what the experts themselves are saying about the U.S. markets. The latest Bank of America Fund Manager survey leaves little room for doubt. 91% of respondents said American stocks are overvalued, and 70% believe the country is heading straight into stagflation. These aren't fringe opinions. Nearly 200 managers took part in the survey, together overseeing close to $500 billion. When people managing that kind of money are nearly unanimous in their view, it carries weight. On the surface, the stock market still looks healthy, even near record highs. But that strength is concentrated in just a handful of massive tech companies. Beyond those names, many sectors are weakening. To professionals, this setup looks like the late stage of a cycle. Glossy numbers at the top masking a shaky foundation beneath. The policy backdrop makes the picture even worse. Inflation was expected to cool this year, but instead, July's core inflation ticked higher to 3.1%. At the same time, activity in manufacturing and trade has slowed. High costs on one side, fading demand on the other. That is the very definition of stagflation. And tariffs are amplifying the effect. Every time the U.S. raises import duties, those costs ripple through supply chains. Producers pay more, and eventually households feel it at the checkout counter. This is where Trump's economic strategy becomes critical. Tariffs were introduced with the promise of shielding American workers, yet in practice they function like a hidden tax. Some of the new duties this year added effective surcharges of more than 80% on imports. Then, within weeks, the administration suspended parts of them, only to reimpose fresh versions later. That kind of instability makes it impossible for companies to plan ahead. Instead of expanding or hiring, many hold back, waiting for clarity that never comes. The hesitation drags growth down at the exact moment inflation is climbing higher. For investors, the dilemma is clear. If businesses raise prices to offset tariffs, consumers lose spending power. If they hold prices down, profits erode. In both scenarios, markets suffer. There's also the risk that foreign buyers of U.S. debt step back, forcing Treasury yields higher and making stocks less appealing. This is why managers call equities overpriced. They aren't speculating. They're running the numbers on earnings, costs, and growth, and the equation doesn't add up. The result is an economy squeezed from both ends. Slowing growth on one side, stubborn inflation on the other. Market valuations remain stretched, but underneath, Pressure is building. And now, all eyes turn to the Federal Reserve, caught between fighting inflation and keeping the market from unraveling. The Federal Reserve now finds itself in a corner with no easy escape. Inflation is picking up again. Prices at the grocery store are climbing, energy costs remain high, and families are stretched thin. Cutting interest rates to give the economy some relief would only pour more fuel on rising prices. But holding rates high keeps the pressure on businesses, makes borrowing more expensive, and risks puncturing the fragile stock market bubble. Either choice carries heavy consequences. The labor market only deepens the dilemma. Recent reports show hiring is slowing, with fewer new jobs created and some industries quietly trimming their workforce. Under normal circumstances, that would push the Fed to lower rates to head off a recession. But here's the problem. While jobs are cooling, inflation isn't backing down. It's a rare mix. Weaker employment on one side and persistent price growth on the other. The Fed is stuck between conflicting signals and risks acting too late no matter what it does. Investors are watching closely, and many don't like what they see. Hedge funds are pulling money out of equities, gold and government bonds are drawing renewed interest, and households are left worrying about the value of their savings. When markets are overpriced and the central bank is boxed in, confidence can unravel quickly. The Fed's indecision is fueling anxiety, and the fear is that a single misstep could trigger a chain reaction across the economy. And if valuations are already stretched, the next question is what happens when that fragile balance finally breaks. When stocks trade at inflated levels and everyone recognizes it, the real question isn't whether prices will fall, but how they fall. If markets adjust gradually, companies and investors can adapt. But history shows that when valuations stretch this far, corrections are rarely gentle. More often, they come as sudden breaks that ripple through the entire system. Take today's stock market. Both the S&P 500 and the Nasdaq are hovering near record highs. On the surface, that looks like evidence of a strong economy. But beneath the numbers lies a different story. Why are stocks still so elevated if so many professionals say they're overpriced? The answer lies in timing distortions created by Trump's tariff policies. When tariffs spiked earlier this year, companies rushed to bring in goods before higher costs took effect. That front-loaded demand, making the economy appear more robust than it really was. Later, when some of those tariffs were paused or adjusted, businesses scrambled again to reorganize supply chains, creating another artificial surge in orders. Together, these bursts pushed the market upward, but neither reflected genuine growth. These aren't signs of corporate confidence. They're survival moves. Companies trying to stay one step ahead of unpredictable rules. Once temporary pauses end and full costs hit, that artificial demand disappears. And with it, the illusion of strength propping up the market. The danger lies in what happens next. If valuations reset slowly, the economy might absorb the shock. But if the bubble bursts abruptly, trillions in paper wealth can evaporate in weeks. Retirement accounts shrink, pension funds lose value, and households cut spending almost overnight. That matters because consumer spending accounts for nearly 70% of America's economy. When families pull back, growth stalls hard. Meanwhile, businesses already burdened by higher import costs won't be expanding to make up the difference. Instead, they'll cut jobs, freeze investments, and pull back on expansion. The decline feeds on itself. Falling markets drag down confidence, and falling confidence drags down the economy. All of this plays out while essentials like food, rent, and energy are still rising in price. What looks like strength today is in fact the product of disruption. Once those temporary boosts fade, the market has no foundation left to hold it up. And unlike past cycles, the usual emergency tools, rate cuts, stimulus, debt-fueled bailouts, carry their own risks in an environment of high inflation. That is why investors are uneasy. They're not reacting to rumors, but to hard numbers and policies that point in one direction. The higher markets climb without real earnings behind them, the harsher the fall becomes when reality sets in. And as tariffs continue to raise costs, the probability of a sharp correction only increases. Investors and corporations are bracing for impact. The real uncertainty is whether the American public will recognize what's happening before it's too late, or only once the shock has already spread. And while the US struggles to hold its footing, another story is unfolding overseas. China is quietly seizing the moment, expanding its trade dominance, and that shift is sending a very different message about the balance of power in global markets. While the US economy struggles under the weight of tariffs, China is charting a very different path, and it's gaining ground fast. In 2025 alone, Chinese exports rose by 6.1%, with July alone climbing another 7%, far above forecasts. This growth is remarkable because it comes at a time when global trade overall is slowing. Even more striking, China's trade surplus reached $683 billion, up 32% from the year before. These aren't just headline figures. They show that Chinese companies are thriving in markets where the dollar no longer dominates, while US exporters are steadily losing ground. This transformation hasn't happened by chance. Beijing has spent years laying the groundwork through currency swap agreements and local currency trade deals across Asia, Africa, and Latin America. Today, when Brazil ships soybeans to China, those deals are increasingly settled in yuan. When Russia delivers oil or gas to India, payments are handled in yuan or rupees instead of dollars. One transaction at a time, the global system is being rewired. For Washington, this is the iceberg looming ahead. Every deal that bypasses the dollar chips away at its global role. And when those deals are multiplied across thousands of transactions, it begins to look like a deliberate avalanche of de-dollarization. That shift leaves Treasury Secretary Scott Bessent in a trap with no clear escape. He can't reverse Trump's tariffs without political backlash. He can't force US exporters to eat the higher costs. He can't stop investors abroad from cutting their exposure to American markets. The only lever left is the dollar itself. By letting the currency weaken, he buys the economy some breathing room, but at a steep price. A softer dollar makes US assets less attractive, drives more trade into other currencies, and feeds inflation at home. It's a downward spiral. In trying to keep the system afloat, Bessent risks undermining the very foundation of American financial power. And as the dollar weakens, global investors are already making their move, quietly reducing exposure before the storm breaks. Investors aren't waiting for the headlines. They're already heading for the exits. One of the clearest examples comes from the Ontario Teachers' Pension Plan, one of Canada's largest funds. In just a few months, it cut its exposure to dollar-denominated assets by 56%. That's more than $50 billion sold off, over half of its portfolio, gone in a single strategic move. And Ontario is hardly alone. Across Europe and Asia, funds are scaling back their US holdings, spooked by a weakening dollar and the prospect of negative real returns. The reasoning isn't complicated. A 10-year US Treasury bond currently yields around 4%. But if inflation runs above 3% and the dollar loses another 10% in value, those bonds guarantee losses instead of safety. What was once the world's most reliable investment starts looking like a trap. The scale of the risk is enormous. Global investors hold nearly $80 trillion in US assets, stocks, bonds, treasuries. A 10% drop in the dollar instantly wipes out $8 trillion in value. If panic spreads and selling accelerates, it won't just be another market downturn. It would trigger a wave of capital flight powerful enough to redraw the map of the global financial system. What we're watching now may only be the first tremors. The real collapse could still be building beneath the surface. And when it hits, it won't just shake Wall Street, it will reshape the world economy. If you want to stay ahead of these shifts, make sure you're subscribed. The next update will take you deeper into this unfolding crisis.